Hello guys, welcome back to my YouTube channel. Recently, I brought my buyer to view one of the units in the East, and this seller agent marketing this unit was really good in introducing the unit and help us to visualize how we can utilize the entire space. But she was a little bit aggressive and kept on harping that this is a fire sale unit. Reason being that the seller got special approval by the authorities to sell her condo and buy a HDB flat without the 15-month wait-out period. But the approval is only valid for a short period of time, so selling at a good price is not a priority. So naturally, after viewing, my buyer got a bit FOMO as he felt that this is an undervalued gem and wanted to offer. Of course, logically, before pulling the trigger, we analyzed the price based on past transactions of similar unit size and third-party valuations. But we concluded that the asking price is actually quite near the fair market price. Eventually, of course, we did not offer because obviously this isn't quite a fire sale, and few other reasons which I will not elaborate here. And all this really got me thinking, as this is not the first time a client has asked me if there is any fire sale unit in the market. Almost all my buyers have asked me this question in one way or another. So in this video, I'm going to address whether we will potentially see any fire sale units in 2024. So whenever you are in doubt or when there's uncertainty in the market, cast your emotions aside and always fall back to fundamentals and data. And I like to build off the fundamentals of the Singapore real estate market using government sources. Why government sources? For obvious reasons, because it is the most reliable. And in this video, I'm going to refer to two of them. Number one is from my previous workplace, the Monetary Authority of Singapore, and it is the MAS Financial Stability Review. And secondly, from Singstat.gov.sg. From the MAS Financial Stability Review, there are a couple of charts I referred to quite a lot to answer whether there are any fire sale units in the market. And to flip the question around is to find out whether the Singapore real estate market is in a bubble or in a stable state. So chart 3.9 over here shows the average LTV for Singapore household in general. And while MAS allows a maximum of 75% LTV, if you average across the board, it is just 41%, which kind of explains why the market did not tank despite the sharp increase in interest rates. And to explain this, if we were to pull up the mortgage calculator, assuming a property price of $2 million and to give a very high interest rate of 5% and loan-to-value ratio of 75%, monthly mortgage repayment is about $8,000. But since the average LTV is only 41%, the monthly mortgage drops to $4,000 over here. And the low LTV is just one of the many reasons why the market did not tank despite the sharp increase in interest rates. So this chart 3.11, shows your household cash versus your household debt. Take a look here, the debt has been increasing over the years, but notice the gap widens more and more, and we are in an overall net positive cash position. And in fact, we currently have the highest net cash position ever. So all the cash available in the Singapore household balance sheet, take it, pay down all your debt, including your housing loan, they still have spare cash. And moving to chart 3.13, let's take a look at the number of non-performing loans in the market. The housing NPL ratio has remained low at 0.24%, and the number of foreclosed units in 2023 is only at 27 units. And I know two of them are actually the GCBs that belong to OK Lim, if you are aware of the Hin Leong case. And at this level, at the GCB level, even with fire sale, they are not within the reach of most people out there. Basically, you want, you can wait lah, but chances are not very high. By then, market would have moved already. On to chart 3.14, and this is a powerful chart for those who are still sitting on the fence and waiting for the market to tank. So pre-2013, you'll notice over here that there are huge swings in the market. It was practically like a cowboy market. In fact, many speculators out there. So whenever there was a crisis, there was a knee-jerk reaction as people did not have the ability to service the mortgage and dump the properties. Hence, the market was very volatile then whenever there was any crisis. But post-2013, with a slew of cooling measures, the market slowly stabilized as most of the speculators have been weeded out of the market. And even with so many external shocks in the recent years, they did not cause huge fluctuation in the market anymore. And on to box B, this shaded part over here. This part you can read if you have some concerns about interest rates because they really deep dive into some of the interesting data points. And if you have read the previous version, the 2022 Financial Stability Review, you will notice that the tone of the report is very different. In 2022, the general tone was that you might want to take a backseat and adopt a wait-and-see approach on the pass-through rate. So what does pass-through rate mean? So what they are trying to say is that there is a delay in the rise in interest rates versus the actual mortgage rate that you are going to pay. Because 2 to 3 years ago, people lock in at a very low fixed rate. You got to wait for the low fixed rate to lapse before they actually feel this increase in interest rates. So in 2022, a high percentage have not felt the pass-through rate due to the lock-in period. But now about 70% has already felt the pass-through rate. And what MAS is saying here is that Singaporeans are weathering it pretty well. And this para over here is quite good in illustrating the correlation between the increase in mortgage and income. So MAS conducted a simulation to assess the debt servicing ability of households that refinance and face a step up in mortgage rates in 2024. So assume borrowers face a higher mortgage rate of 4% upon refinancing from their lower fixed rate. They will face an increase of about $790 or about 7.5% of their monthly income. But income have increased by 10% in the same period. So this means that income increased more than your mortgage increase. So they should be able to weather it pretty well. Next, MAS stress tests a more serious scenario with interest rates at 5.5% and a 10% loss in income. And results still show that households would still be able to service their mortgage even under such stress. Although a small segment of highly leveraged borrowers with below the median household income could be vulnerable. And this only accounts for less than 5% of the total mortgages. And onto the second government source, Singstat, let's pull out the household sector balance sheet and see the trend over the years. I've extracted the data and put them in Excel so it is easier to visualize. You can see that I've put out data from specific period. 1997 was during the Asian financial crisis, 2003 was during the dot-com bubble burst, 2007 was during the global financial crisis, followed by the latest data. So last time during the previous crisis like your AFC, dot-com bubble burst and GFC, there is real wealth disruption. But in the last 10 years, for most of you out there, was there any real wealth disruption? Yes, I know people do lose a bit of money in the stock market, but no significant wealth disruption in general. And people tend to misinterpret that high interest rate, demand for real estate disappear. In fact, cash is not lost. It just means that money is parked aside more and more. Because now fixed D is easily 3.5%, and if mortgage rates were to fall back to 2%, fixed deposit will have to be lower than that because banks have to earn money. By then, fixed D will be probably revert back to 1%. By then, what will people start to think? So putting money into fixed D cannot even outpace inflation. Waste of time. Then people start to look to deploy resources elsewhere. So you can see from the Singstat data over here that currency and deposits along with your CPF have been increasing over the years. And these two are essentially the firepower for your property market. And if you refer to the various financial ratios at the bottom, you'll notice that our household net worth has increased over the years. Conversely, debt as a function of total asset has decreased. And it is also interesting to note that the residential property asset as a function of our total asset has declined too. And so this table really gives you a behind-the-scenes glimpse at how stable the property market is. And I read a lot into all this because this forms a very firm base on my conviction of the market. To sum up, the risk of default remains low. And I think that these two government sources help to build the fundamental understanding of the real estate market before we head into 2024. And sometimes you hear from your friends and family or read headline news by these so-called analysts that market is coming down. Wait a while more, fire sale coming. Always fall back to the fundamentals and data which I shared earlier, and most importantly, do your own due diligence. If you have been in the market for quite some time and is someone who likes this kind of data and a systemic approach to property investing, do reach out to me via my WhatsApp below. We can meet up for a quick 30 minutes non-obligatory kopi session and I will share more in detail. And similar to my last video, I have a $100 cash prize to give away. And what you have to do to win the money is just 3 simple things. Number 1, subscribe to this channel. And number 2, like this video. And number 3, most importantly, comment on whether you think the real estate market will continue to go up, plateau off, or come down. And of course, the reason why. So that's all for today. See you in the next one. Bye bye.